Hello everyone, I am Dr. Muhammad Jamil, working as Professor of Economics on Ghulam Sakha Memorial Chair of State Bank of Pakistan at Kashmir Institute of Economics, the University of Azad, Jammu, Kashmir, Muzaffarabad. Before this, I was working as Associate Professor in Qaidian University, Islamabad, and I took my PhD from the University of Vienna, and I did my master's from same Qaidian University, Islamabad. And since 2011, I am teaching in different universities and engaged in research and supervision. My main area of specialization is finance. So today I am presenting my paper, which is co-authored with one of my students, Azad, and the title of the paper is Transformation of Financial Technology in Prospective of High Economic Growth. So let me share my slides. Transformation of Financial Technology in Perspective of High Economic Growth, co-authored with Azad. In this paper, we rank different countries according to the use of financial technology using the spatial graph, try to highlight the differences among the different countries. And then at the later part of the paper, we try to see the effect of the financial technology on the economic growth on average. So the line of presentation is first I will talk about FinTech, and then in the introductory part, try to differentiate the FinTech from the financial inclusion. And after a short history of the FinTech, I will present the objectives of the study. And after the review of the literature, we present the methodology and data used in the present study. And after the results, I will conclude my presentation. Financial inclusion and FinTech. Financial inclusion is basically the use of formal financial institutions, bank, for the financial transactions, whereas the FinTech is the use of technology for the financial services. So paying or receiving the funds without a formal financial institution, but with the help of the technology. Or it can be mix of both, that with the formal financial institutions as well as with the help of the technology. So FinTech is the combination of two words that are finance and technology. We can define that it is the new financial industries that applies technology to improve financial activities. According to Bali FinTech Agenda, advances in technology that have the potential to transform the provision of financial services, the development of new business models, applications, processes, and products. According to the SBP website, FinTech is technology-enabled financial innovation, which is changing the way financial institutions provide and consumers and businesses use the financial services. According to Thakur 2020, FinTech indicates the innovation in the payment system, which includes Bitcoin, cryptocurrencies, and credit markets involving P2P lending transactions and blockchain technology, which makes secure transactions. FinTech is an alternative payment system or another infrastructure for the banked or unbanked population. So we can conclude that FinTech sector is deploying and using latest technologies, including big data, analytics, clouds, Internet of Things, blockchain, and artificial intelligence to provide highly secured, instant, easy to access, easy to use, low cost, and finally more customer-centric financial services and products. If we see the financial inclusion, there are different terminologies which are related to the financial inclusion: financial education, financial literacy, financial capability, financial awareness. Financial education is the process by which individuals improve their ability to interpret information and assess advice. Financial literacy is the ability to make informed decisions and take effective decisions regarding the use and management of money, what to buy and where to buy. And the financial capability encompasses financial literacy with other social and emotional factors that influence consumers' money management. And financial awareness, and understanding of basic financial terminology used in financial management and the ability to construct and maintain simple financial records. According to the United Nations, a financial sector that provides access to credit for all bankable people and firms and savings and payment services to everyone. Inclusive finance does not require that everyone is eligible to use each of services, but they should be able to choose them if desired. In 1865, the pen telegraph was invented by Giovanni Caselli. It starts operation between the two banks. One was in Paris, another was in Lyon, and that was just to verify the signatures of the customers. In 1880, consumers and merchants exchanged goods using credit for the first time in the form of charge plates and credit coins. In 1918, the FedWire Funds Service is established by the Federal Reserve Banks to transfer funds and connect all 12 reserve banks by telegraph using a Morse code system. In 1919, an important book, The Economic Consequences of the Peace by John Maynard Keynes, was published, linking finance and technology. In 1950, modern-day credit cards are introduced, starting with Diners Club. In 1958, American Express introduced their credit cards. In 1960, Fortran allowed stock market codes to be shown on the screen. In 1966, Telegraph replaced the telex network. In 1967, first ATM installed by Barclays Bank. In 1971, National Association of Securities Dealers automated quotations. NASDAQ was established. In 1983, evolution of e-trade and online banking. And 2009, it was the release of the Bitcoin. And 2011 is the Google Pay establishes Google Wallet. Google Wallet that is used for the tap payments. And in 2015, Smile to Pay services introduced by the Alibaba Chinese e-commerce company led by Jack Ma. So if we see in history, in the 19th and 20th century, this particular evolution tried to replace the human capital for the placement of orders. And from the 1997 till 2008, ATMs, online banking, and mobile phone were under concentration. And 2009 and onward, Silicon Valley and IT startups are in discussion. So after the release of Bitcoin in 2009, the use of technology is having a new shape every year for the financial services. That's what we are calling the FinTech, the technology used for the financial services. The objectives of the study are to conduct a spatial analysis for FinTech adoption across the selected countries, and to make the comparison of Pakistan with other South Asian countries, to empirically explore the behavior of FinTech over time using panel data models, to conduct the cross-regional and income group comparison of FinTech development and its impact on economic growth using panel data models. Now, based upon these objectives of the study, I will present the review of the literature. Literature is relatively new in this particular field. Some of the studies try to see the FinTech and financial inclusion linkage between them, and others try to see its effect on economic growth. Some of the study checked out the performance during the COVID-19, and some of the studies try to relate them, the FinTech, with the banking sector, and others try to see its effect on other macroeconomic variables. Now, the summary of the literature is as follows. GPFI 2014 and SSRI 2021 were of the view that FinTech can help countries to increase financial inclusion. Digital payment is first point for unserved, unbanked, and poor people to enter into the formal financial system. After 2016, cash transfers have become an increasingly important component of social protection. The introduction of mobile money systems in many developing countries offers new opportunities for distributing cash transfers. So they go to 2020, FinTech development countries to economic growth by increasing GDP generated in the financial sector and indirectly by increasing e-commerce turnover and real sector financing. In particular, by creating more favorable lending conditions for small and medium-sized businesses. In another study, it also provides an opportunity to Pakistani government to save $7 billion
by preventing leakage of tax and stopping illicit activities. It also has potential to create 7 million jobs in Pakistan and also can boost the percentage of GDP by 7% until 2025. FinTech provides platforms for industries to boost their efficiency, which ultimately increase the growth. Financial inclusion provides the baseline for advancement in FinTech. Number of studies reported that FinTech positively contribute in poverty reduction, economic growth, saving, borrowing, and remittances. FinTech improved international trade and made easy payment in new development of IT infrastructure. Number of studies from recent years, FinTech highly contribute in the banking services to financially include the unbanked population. So that will increase the financial inclusion as well. And some of the studies try to see that and found the performance of FinTech during COVID-19 and indicated this thing that their performance was worthy, that was useful. The use of digital services increased in the pandemic. So based upon this literature, why FinTech is important, we can list down the number of reasons that FinTech enable new technologies to enhance financial service provision. It reinforce competition and commitment to open, free and contestable markets. It fosters FinTech to promote financial inclusion and develop financial markets, monitor developments closely to deepen understanding of evolving financial systems, adapt regulatory framework and supervisory practices for orderly development and stability of the financial system. It also safeguards the integrity of the financial system, modernize legal frameworks to provide an enabling legal landscape, ensure the stability of domestic monetary and financial system, to develop robust financial and data infrastructure to sustain FinTech benefits. It also encourages international cooperation and information sharing. It also enhances collective surveillance of the international monetary and financial system. So there are a number of reasons why FinTech is important. That is why we try to see that how different countries are adapting this particular FinTech. Now I will present the methodology of the present study, talk about the data and data sources and issues with the construction of the index for FinTech. Our analysis is in the two steps. In the first step, we used FinTech and spatial mapping to highlight the differences among the countries and that which of the countries are higher in terms of use of technology for the financial services and which of the country is lagging behind. In the second step, we use the regression analysis to see the effect of FinTech on economic growth. In the other analysis, we use labor force and trade openness as the control variables in there. Data is taken from the two different sources. Financial data is from the Global Fund Index Survey and macroeconomic variables data is taken from the World Development Indicators. Global FinTech Survey is available for 4 different rounds for 2011 for 148 countries, 2014 for 143 countries, and 2017 for 144 countries, and 2022 127 countries. We also estimated the model for different time periods using the cross-sectional regression to check the robustness of our results. Construction of FinTech index is an important part of the study. We use 5 different dimensions for the construction of the index: access of account, payments, use of financial services, savings, and borrowing. In excess of accounts, we have 3 different indicators. We try to see that how much percentage of population is having ownership of their account and how much population is having formal financial account and how much of them are using the mobile money account. We converted this percentage of population from 0 to 1. 1 is for the country whose highest number of population is using that particular account. And 0 is for that who is having the lowest population in that particular variable. Then we average of these 3 0 to 1 indicators is used to rank the country for the access of account. Similarly, for the payments, we use 4 different indicators. How much percentage of population is having debit or credit card, how much percentage of population is using mobile phone or the internet to make payments, how much percentage of population receives digital payments, and how much percentage of population use this technology for the utility payments. Again, we convert these indicators into 0 to 1 rank, and then average of these 0 to 1 converted variables represents the country rank in terms of the payments. Likewise, for use of financial services, we have 5 different indicators. We converted all of these 5 variables into 0 to 1 rank, and average of those 5 0 to 1 converted variables represents the country rank in terms of the use of financial services. Then savings and borrowings, we have 3 different indicators. So it means that we have 5 different dimensions. Then average of all these 5 different dimensions, equally weighted average, presents the FinTech of country J. So we use this index for the mapping as well as see the effect of FinTech on economic growth. Now I will present the results of my study. In the first step, I will present the results based upon spatial mapping, and in the second step, I will present the results based on the regression. If we see this, the count ownership of adults across the countries, this is the average percentage of population between 2011 till 2021. So this indicates this thing that African countries are deprived in terms of the account ownership and showed very low access to account ownership, whereas European countries and the developed countries indicated very high access to the ownership. Globally, FinTech increases 50% during the time between 2011 to 2021. In high-income economies, account ownership reaches up to 100%, like United Kingdom, Germany, and Canada. And middle and low-income economies, FinTech ranges between 30% to 76% in 2021. In South Asia, Pakistan experienced 10% growth between 2011 to 2021. And India ranges between 35% in 2011 to 78% in 2021, which was highest in South Asia. Sri Lanka experienced 74% account growth during this time. Now, if we see the spatial map of FinTech for the years 2011 and 2021, in these maps, countries are divided into 5 different groups in that particular year. So it might be possible that there is increase in FinTech in a particular country, but it falls into a lower group because other countries have grown at a faster rate. Behavior in FinTech is different across the countries, and that can be observed. FinTech across different regions are not the same. Yearly, the adoption rate increases with time. The selected sample made progress. Either it was very slow or for some countries it was very fast. Economies such as Denmark, Canada, New Zealand, and Australia enjoy the highest adoption rate. These economies were highly developed. Economies like Pakistan, India, Bangladesh, Togo, Ghana, Uganda, etc., or the other low-income economies or low-middle-income economies can hardly adopt technology because of lack of education, technological skill, fraud, and weak internet. Now, if we see the FinTech across different time and space, we can see that adoption FinTech is very low in South Asia and very high in Europe and North America. Adoption is high in high-income countries and low in low-income countries. Global FinTech Survey 2021 reported that 55% of world population use technology for payments, saving, and borrowing. Among the regions, the use of FinTech is highest among the other regions as compared to the South Asian countries. And Sub-Saharan Africa also has the low rate of financial technology as compared to the other regions. Afghanistan and Bangladesh experienced the lowest averages of 0.025% and 0.049%. 72% of Maldives population pay online, whereas in Pakistan, only 0.19%, and in India, it is 0.26%. In high-income economies, 95% of adults made payments using
the technology. Now, if we compare the FinTech across different regions and compare the FinTech index that we have created with the Digital Adoption Index, that is of World Bank, so we see the similar kind of trend across different regions. But the level and the magnitude of the index are different, but the pattern across different regions is almost same. Digital Adoption Index of World Bank refers to the digital adoption in three dimensions. Behavior of regions shifts towards digitalization, adoption of technology by the government, and business behavior towards digitalization. So FinTech and DAI shows the positive trend in all regions like South Asia and Sub-Saharan Africa. Trend is positive but low in contrast with other regions. In North America, it is not worth saying that FinTech remains at access to the technology, but it moves towards great FinTech startups. Population lacking financial services mostly belongs to South Asia and Sub-Saharan Africa. The reason behind that might be the low literacy rate in contrast with other regions. Technological education is the most important factor for the adoption of FinTech. Now, if we see the FinTech across the South Asian countries, FinTech is growing rapidly in South Asian countries, but the growth rate is different among the different countries. Pakistan is among those countries having half of the population remaining unbanked. Growth rate in FinTech is positive but not appreciable. From 2011 till 2017, FinTech growth only 10%. India experienced positive growth in FinTech and favorable economic conditions from the middle income group. India are ensuring its place in high income economies. Sri Lanka experienced highest adoption rate among all the South Asian countries because of the different programs launched by Sri Lanka government over this time period. Now, presenting the regression results of the study, the results indicate this thing that FinTech positively contributed in economic growth for all the regressions. The results of FinTech concur with the above section of spatial analysis that the overall average of FinTech is increasing economic growth, but its effect is different across time and income groups. This high effect of FinTech might be because of the potential output gap in the less income countries. So now we can conclude this study. The study explores FinTech as a bridge for sustainable development in the current era. FinTech behaves differently as per the income group of the country. A risk factor is highly involved among the low income group. Pakistan, in contrast with the South Asian countries, shows a positive attitude towards adopting financial technology. There is a high risk factor involved in Pakistan because there is a lack of financial infrastructure in the country. As compared to India and Sri Lanka, its performance is low, but as compared to other South Asian countries like Afghanistan, Bangladesh, and Nepal, its performance is relatively better. The regression results reported a positive effect of FinTech on economic growth and shown more effect for low-income countries because of high output gap. Central banks, regulators, and governments around the globe are embracing FinTech continuously to achieve the goal of financial inclusion, which will be digital financial inclusion. So education is a very basic thing to adopt the technology. It's hard to adopt the technology without basic education. Government should ensure basic education of individuals in developing countries if they want them to use this technology for the financial services. So we can conclude that FinTech is a chance for the developing countries to catch up the speed of developed countries by paying more attention to the use of technology for the financial services, and they can catch up the growth speed of the developed countries if they can catch the growth speed of FinTech of the developed countries. So that's all from my side. I hope that you have learned about the FinTech and the adoption of FinTech by the different countries and its effect on economic growth and how the developing countries can make a difference by changing their strategy towards the FinTech. And this is the first time that I was recording my presentation, so there might be a lot of mistakes. However, you can place your questions as per the guidelines of the organizers of the conference, and I will try to answer all of these questions. Thank you. Stay blessed. Bye bye.